I'm Peter Sturgeon with Sorenson Capital. I've been with Sorenson Capital since 2006. We are a middle market private equity and growth equity firm. We actually have a $100 million venture capital fund. That's so early stage. We have a $400 million fund that we do both growth equity and buyout from that fund. We typically invest across 4 very broad industries. The predominant one is software and technology. Second most common for us is healthcare, whether that's healthcare services or healthcare IT. And then we also do energy and aerospace. Our typical growth equity investment is usually between $10 and $50 million of revenue. A buyout would be typically between $5 and $20 million of EBITDA. And then our venture fund, of course, is earlier stage investments. And I'm based here in the Phoenix area. We're actively looking to be more involved in making Arizona investments. We think it's a promising market. And so happy to be here.
Hit your hold period too, if you could, in your hold strategy.
Yeah, we try and be flexible. We do both minority and majority investments. Again, trying to be flexible. As we've heard, the market right now is very company friendly, and so we try and be very flexible both on how we structure investments as well as how long we hold investments. We average around 5 years. We've gone as long as 8 or 9. That's usually either an exceptionally good story or an exceptionally bad story if that happens. 4 to 6 is pretty typical.
Thanks, Peter.
My name is Chris Brown. I'm with MONTAGE Partners. We're a private equity firm here in Scottsdale. I've been with them about a year. We've been around for about 15 years now, kind of investing in the Southwest U.S. That entire time. We can do minority, but typically we're majority only, doing buyouts of established companies that have been around a while, typically with at least 5 years of operating history. And our investment criteria is really any company with 1 to 5 million of kind of sustainable EBITDA. So we're really working in that lower middle market, a little lower than Peter's firm here. And industry-wise, we have pretty broad interests. So we like tech, industrial, consumer products, business services, and healthcare. And we've done at least one deal in each of those except for healthcare at this point. No particular reason, just haven't found the right company or the right deal to do that. And we really like investing in the Southwest U.S. and Arizona specifically. We think it's a great market. It's got a lot of the type of companies that we're looking for, which are those successful founder-owned businesses. And looking forward to continuing to do that and helping Arizona business grow.
Yeah, I paid them last night to say that, by the way. No, I'm joking. Arizona's good.
So my name is LENA DALBEY. I'm with Link Capital. We both invest in and advise extraordinary companies. I call it user-friendly private equity because if we're the right fit, we're happy to invest. And if we're not the right fit, we'll find you who is. So I have a lot of experience both on buy side and sell side and am more concerned with helping companies navigate their future successfully, regardless of who the right investment partner is. So a little unique, technically that's called merchant banking, but I like to think of it as user-friendly private equity. And we're definitely the first capital in, outside capital inside closely held private companies. So we're oftentimes, the first investor to work with companies in a context of migrating them towards doing bigger deals with my friends here on the other side of the panel.
I'm Mike SMIGGEN. I'm a partner here with MONTAUK Corner Partners. We're a private equity fund based here in Scottsdale. My partners and I just formed the firm here in the last few months, as a matter of fact. We are looking for investment opportunities in subordinated debt as well as minority equity positions. So we're not looking for scenarios where we're taking a control equity position and running these businesses, but we would go in and invest in a scenario where someone like Chris or Peter's firm might be coming in and they need some extra capital to complete the financing. We'll also do transactions where the owners may be looking to take some chips off the table, but not quite ready to sell the whole business just yet. We're focused on the southwestern U.S. in terms of where we want to invest, and we're focused on 4 broad industry sectors. Specialty manufacturing, value-added distribution, business services, and healthcare, although healthcare without any Medicaid or Medicare reimbursement risk. We would avoid healthcare that has those challenges.
All right, next one goes to Chris. We are not going to be outshone on the storytelling side, so we're going storytelling here. Give me your best deal story. It's got to be a juicy one.
Oh, my best deal story. Okay, so we were looking at a manufacturing company based out of Texas that I don't know if you guys are familiar with the maquiladora industry, but it's where goods are shipped into Mexico, they're pieced together, and then shipped back into the U.S. And so we were in diligence with them and flew out to visit the company and wanted to go see the factories, which are based in Mexico. And so one of our partners gets out there and crosses the border, and when he happened to be there, there was a massive labor strike going on, and so the town itself was a little bit wild. And needless to say, he came back from that trip, and we decided not to continue forward on that one. I don't think it was the most well, maybe it was an exciting time for him, but that was an interesting deal that didn't end up happening. But yeah.
I love it. I love it. Okay, we're going to switch off a little bit. Let's get to deal structure, Peter. What does typical deal structures look like? Who else is involved? How are you interfacing with partners? And kind of think it through the structural side of it.
Okay, sure. Let me talk about buyouts because I think those are the most complicated. So that's a more mature company where the founders or owners are looking for either partial or full liquidity from their investment. And in those investments, typically you have a company that is lower growth. You know, maybe they're growing 10% a year, maybe 20% a year. Versus a growth equity for us, those companies are growing 50% or 100% a year and typically are on a much quicker trajectory. And so those structures typically are levered investments where we will bring in a senior lender and a mezzanine lender, such as Mike and his firm. And that's a complicated process. All of the different service providers that were on the last panel are involved in that single transaction, and usually the same crew from the seller side and the buyer side for most of those. And so you're coordinating a lot of different parties there to make that transaction come together. In the current environment, I think debt ratios are quite high, often 5 to 6 times, even in the middle market, which is atypical. Our fund typically doesn't go over 4.5 times leverage on our buyouts. Just the nature of middle market companies, you have less stability of cash production than you do for larger companies. So
Cool.
That's a little bit on structure.
Mike, go for approachability on a company. What do you want a company to do to approach you as a PE? What are the ideas you're looking for, and also what's the readiness stage? And talk to us about that.
Yeah, I mean, in terms of how they approach us, I'm frankly indifferent as to how they approach us.
You just want them to approach.
Yeah, exactly. If it's a good
Deal flows
opportunity,
good.
I just want them to approach us. In terms of what we want to see within that business, first and foremost, we want to see a strong management team. One of the lines we use as a group, and one of the things we tell people is, if the management team's not right, the rest of it doesn't matter. I've seen it before where good companies have been brought down is the wrong word, but good companies have failed to fulfill their potential because of subpar management teams, and I've seen mediocre, mundane businesses really excel because they've got the right management team that knows how to pull the various levers to either grow the business when the opportunity exists or limit the damage when a market perhaps turns against them. Having the management team that knows how to run the business and knows how to provide the information to us that helps us understand the business. Those are some of the key things when we're first getting introduced to a company to help us go from introduction to, yes, I'm interested, I'd like to learn more and take the next steps.
Great. Lena, talk to us about the stock market influences on your deals, your exits, high valuations, and how that influences your thought process on investing and what impacts that has.
Wow, surprise question. Well, I think that change in the public market has just been an incredible opportunity for private equity because being a public company, right, has become costly and expensive, and of course a great solution for the large unicorns, right? But it's, so much of that demand, I think younger companies now, instead of dreaming of being a public company, right, they understand that there's an avenue for growth and success and liquidity, but in a private market context. So while the public market can still be a great exit strategy and a lucrative tool, right? For some companies, I think the majority of companies now understand that the path to private equity, right, can yield the same opportunities, but in a different context. So I think private equity has never been more exciting and never been more flexible, and is filling a big gap that's been created by the size of the public market.
Chris, what do you got?
Yeah, for us, the public markets haven't had too much of an effect. I mean, the size of the companies that we're investing in are 1 to 5 million of EBITDA, maybe 30 million of enterprise value and down, and that's so far removed from the public markets that if there's been any effect, it's just been a bit of a spillover of investors looking for return, going to private equity, bigger funds moving down market a little bit, looking for better deals, and that eventually spilling into kind of our space. But for the most part, not too much effect on our kind of day-to-day investing strategy or anything like that.
Let's talk about the deals at your door. Now we're going to close it. What have been some of the largest hurdles, challenges that you guys have seen? Is there a common theme that goes across that, or is it just crazy deal by deal, or unique situational closings? Anybody can take it.
I think every deal's crazy. I'll just start there.
People are crazy.
Yeah, there's so many things that have to come together for a successful investment. I think the current environment is, as I mentioned before, is very company friendly, and I think for a deal to come together right now, for an investor like those of us that are on the stage, you have to really find an opportunity that is very compelling, because the prices for A companies is always high, but right now the prices for C companies is also very high. And so there is a lot of pressure to be able to identify companies that really have a unique growth story. If you overpay for a company that is growing 50% a year, you're going to grow into that valuation pretty quickly, right? Because the company's going to catch up with what you paid for it very quickly. If you miss and you overpay for a company and their growth slows down to 10% or even goes negative, well, you can't recover from that as an investor. And so I think that's the biggest challenge right now is balancing doing work on every opportunity that you see to try and find those gems, but also being realistic that you might be putting in 2 or 3 months of work into an opportunity, and it may not end up being a deal that you can close.
Anybody else want to add to that?
I'll add to that. I think the sector in which we play, being that first capital source in closely held Arizona companies, we've heard some really interesting themes today about whether there's frustrations in the financial function or gaps in the management team or things that the entrepreneur didn't know. That is all a really exciting opportunity, right? A really exciting opportunity to help those companies succeed and learn and grow and mature. So as I hear some of the frustrations or the horror stories or the messiness, in my view, sometimes the messier the better, the less sophisticated the better. You had this, you asked a question about like a crazy deal recently. One of the control investments we did about a year ago, a company had $72 million in sales and no internal accounting function. Zero. Right? You say, how does that happen? Well, it did. And therein lied, an unbelievable opportunity. So, I love our local, messy, crazy companies here because it just creates great opportunity to add value and help them succeed and grow up and become larger companies.
Well, let's hit Arizona just a little bit. So talk specifically about deal flow in Arizona. What are the advantages, disadvantages? What do you see that you like in the market or that you don't like in the market? And we can talk.
Yeah, so I moved here to Arizona 9 years ago. And one of the things that struck me fairly quickly was the number of companies and the number of good companies, good size, should be thinking about private equity. The number of those companies that really fly below the radar, that people don't know about, and you hear the deal has happened before the rest of the market knew, or before a lot of the market knew the company even existed. And I found that interesting coming from, I came here from Minneapolis, and the private equity and investment banking market in Minneapolis and the upper Midwest there it is pretty well put together, and it's been in place for a long time. And so even business owners who have small companies hear about private equity and investment banking and understand where the various parties fit into their growth plans, just because it's more part of the common business conversation. And I didn't find that to be the case here in Arizona. And I think that's changing. We were talking last night at dinner about the number of new venture funds that are being raised here. That'll have a long-term impact on what's going on. There's more companies here moving from other areas of the country that have experience with the capital markets, and I think all of that means good things for Arizona going forward.
Yeah, Pete, I'd like to also hear from you also on that, but just to give some context, $850 million of venture capital has been announced, new funds in Arizona in the last year. So that's a pretty significant change from where we had been before. We had a couple of $75 million funds here, maybe even smaller, and that's a big, big change for us.
Yeah, and we're $110 million of that, and we think the opportunities for this region are accelerating. It is a market that, from a financial sophistication and from a deal flow perspective, is behind, but I believe it's catching up, and I think we're seeing more activity from all stages, from angel and seed investing through venture, through growth, all the way to the buyouts, and so I'm optimistic about that. I want to comment on kind of this theme of sophistication, and I do think that the ecosystem here is sophisticated in terms of intermediaries, lawyers, sophisticated accounting firms, et cetera. And so I think the partners are there for these CEOs and owners to find. I think there's a Mark Twain quote that says, "It's not what you don't know that hurts you, it's what you think you know that isn't so." I think the problem you have for a lot of businesses here, where the owners think they know what they're doing because they heard it on the golf course, but they don't actually have the right people around the table that have been through it before. And so I think a lot of the pain for the Arizona deals that we've looked at has come from false starts, where you hear this and then you come in and you get the data and it's dramatically worse. And that happens in all markets, but it happens quite a lot for us here.
Yeah, I'd just like to add to that a little background. I raised $75 million of venture capital funding in my startup a while back from Battery Ventures here, and that was a big deal. That no one was doing it. It didn't happen for a while after that. And when I looked at it, I asked a lot of founders, "What are you doing? You're in a incubation stage of your company. Would you like to approach venture?" And there was a lack of trust on the venture side. And I think it was the myths, the kind of concerns that venture capital was going to come take everything from them. So I want to kind of relate that now to the trust concept and maybe the myths or other things on the private equity side. And how does that relate? And what comments do you guys have for that? And how can we educate that and move that forward? That can go to anybody.
I'll talk a little bit about it. That's one of the biggest challenges in the early stages of getting to know a management team and the owner or ownership group is developing a trust between the private equity firm and that management team ownership group. Initially they don't know you. We don't know them. We're asking a lot of questions. We're asking a lot of them multiple times. And that can, and this process, maybe to start with, this process for the business owner can be a very, very emotional process. This business is their baby. They started it from nothing and grown it to wherever they've gotten it to. And for the folks coming in to invest, it's a more black and white approach. I'm not emotionally tied to their business, and I need to recognize that for them it's a very emotional process and acknowledge that. And we need to be aware that when we're asking these questions, that it can be taken personally when it's asked multiple times, and we're asking to have various information confirmed in various ways. And the owner also needs to understand that it's not a distrust on our part, but we've got a fiduciary duty to ourselves and to our investors to make sure that we're getting good information and correct answers. And so that whole process takes some time for each side to develop the trust it needs. And without that, you're starting off on a bad foot, and the deal won't go well if you don't manage those early conversations well.
Yeah, I mean, go ahead, Lena.
Oh, I just found myself thinking perspective is everything. We've heard a lot of really interesting comments during the afternoon, and I keep thinking to myself, in some ways the capital markets are really efficient, right? Because when you have high supply, high demand, you're matching the objectives of one party with the other. But on the other hand, and Jerry, I love your term, beautiful fear, they're also beautifully inefficient because it's actually tricky to find one another, right? And tricky to find, and as a matter of fact, you were sharing last night, it still takes you 100 deals to find one. Right, and I've been on both buy side and sell side. So that means when I'm on the sell side, guess what? I'm the 99 a lot, right? I have to overcome objection all the time. So the idea that we actually find each other, right, and connect and complete transactions is extraordinary. And so you have some questions here about how do I find it and how do I source that? That takes the time and effort and diligence, and that's why it is a two-way street and a partnership and all those things. But I find the process of finding one another pretty fascinating, and finding the right fit is a beautiful thing.
Yeah, I think the approachability side is one thing. You guys have, time is critical, right? How many deals you can go through and how many meetings you have. So you're going to look at, the factors that hit your window, whether it's $2 million or $10 million, $15 million EBITDA. At what point do you start watching the trailer and start to build that relationship and nurture the relationship that you might have as that company's growing? Do you have time for that? Is that something in the cycle?
I think everybody tries to do that, and it's very difficult because, like you said, one of the nice things for companies and bad things for us as investors is we have to invest capital. That's what our investors want from us is we have to invest a certain amount of capital within 3 to 4 years or maybe 5 years. And so you're constantly looking for opportunities that are ready to be done that year. And you want to plant seeds along the way and build relationships. And we certainly do that on our venture and growth side quite a bit. But it can become a very time-consuming part of your job as an investor, and it can overcome kind of your short-term objectives. So we try and do that, but it is I can't tell you how many times it happens that you build a relationship with the company, and this literally happened this week. I talked to the company in February. Great, we're going to raise capital in August or September, and then yesterday I got the press release that they'd raised capital. So, and
Did they send you flowers, candy?
That's okay, but you can understand why investors are a little reticent to invest too much into that because, look, the company has to do what's best for the company, and sometimes when you get the right offer on the table, the right thing to do is to move quickly, not to call the 15 people that have reached out to you in the last year.
Awesome. All right, well, let's open it up to questions. Any questions in the audience?
What are the two most important things a CEO should look for when considering private equity partnership or arrangement? What two factors?
Go ahead, someone jump in on that.
I'm not going to cheat. We know each other.
Okay, so there's a relationship. Mike?
I would say the number one factor for me, and I think should be the number one factor for the CEO, is finding a group that shares their vision for where the company's headed. And if that's not the case, if I've got a different idea as to what the strategy ought to be and what the vision ought to be, compared to what the CEO and his or her management team is thinking about, we're going to complete the deal, and then we're going to be button heads for the next 5 years trying to advance the ball when each of us thinks it ought to be advanced in a different way.
Yeah, I would echo that strongly. We looked at a company that we loved last year here in Phoenix, and we were down to the final two, us and another firm that were considering the investment, and went through a strategy session with the company, and it became very clear that the strategy that they wanted to pursue for the business was not the strategy that we would have recommended for the business. And so I think alignment of vision is incredibly important. The second is really the intangible relationship and the ability of the firm to actually bring value to the company beyond the capital, and we've heard a lot about that today. But you have to know yourself as an executive, and we have some teams that come in and they thrive on having a partner that's going to be vocal, which we are, that's going to have a view in a board meeting and is going to challenge them. And we come across other executive teams, and the culture is very much, hey, when the CEO speaks, the conversation's over. And that CEO needs a different partner than us, because that's not the way we go into investments. And so I think finding that intangible fit, the investors are betting on management teams. The companies are betting on that lead partner or the team from that investment firm to come in, to have the chemistry to be able to actually add value and work as a team, because they're going to be part of the team for 5 years and maybe more.
Yeah, I lied. I will say a couple of things. It's, and you know, we heard great stories about character and culture, right? Because capital is ubiquitous. Capital, the cost is pretty efficient. So I love your word chemistry. So I'll go with the 3 C's, that chemistry, character, and culture.
That's awesome. Other questions?
I love that you just went there, because it was interesting having our private equity team look at us, evaluate us, and then be side by side when we look at follow-on acquisitions. And everybody says they have, one term that always comes out is prove it with data, prove it with data, prove it with data. And everybody says they have a great culture. Do you guys have any tricks, any suggestions on how someone might really be able to prove that, and how you are able to evaluate it? And a follow-on question, does anybody on the panel have a history with somebody else in the audience that might have
Skip that second question.
So when it comes to culture, I think when we think about the brand of a company, we think about it twofold. We think about the brand to the outside world and also the brand internally. And I think one way to identify that you have a strong internal brand or a strong internal culture is, you know, how are the employees happy? You know, what's the employee retention? I think will say a lot about the culture of the company. If they're happy, they're probably not going anywhere. And so I think that's one data point that can point to a strong culture or a weak culture, is what kind of turnover is going on in the business. You know, are most employees out of there within a year? Probably a pretty weak culture internally, probably not the best internal brand. Are all their key employees, have they all been there for 5, 10, 15, 20 years? Probably a really strong internal culture, probably a great internal brand there. I think that's one data point that can help crystallize that into a number, so to speak.
And the beauty of reverse diligence, right? You've heard some guys, you know, that were beat up on a diligence front, and you get to turn the tables too, right? And there was, someone made a comment earlier about don't call the references that they supply, right? You know, call people. So the beauty is, you know, you can find references in that reverse diligence, turn the tables, and do just as much work on us, right, as we do on you. And don't be afraid to do so.
Yeah, I would always ask for references for deals that have gone poorly.
Yep.
You learn a lot about your investment partner when you talk to people who have really been through the trenches. In terms of evaluating culture, as an investor, we like to interview several layers down in an organization. When you have an investment banker that is shepherding a process, there's an awful lot of coaching that goes on. And so you will meet 6 executives, you will ask them 10 questions, and you will get the exact same answer from all of those executives. And great, you're well coached, it's a good story, but we're going to try and interview the level beneath and start to ask questions about, you know, how are they liking the company? What are the strategy things that they're most excited about? And you start to hear different themes as you go down the organization. And candidly, when we have an investment banker tell us you can't do that, we back out of processes, right? Because we're making investments that are $30 or $40 million. And if we can't talk to, you know, it's like they say, never move in with somebody you've never been on a road trip with, right? There are certain things that you need to do to get to know an organization beyond just, you know, the well-coached, the well-manicured presentation that an investment banker is going to give you.
I like that.
Yeah, you've got a brief courting period with whoever your investor may be. It's 60, 90, 120 days, and then you're roommates for the next 5+ years. And so it's real important to learn as much as you can about one another during that period. And I want to stress what Lena had mentioned a moment ago about the owner, the management team, asking questions of and quizzing the PE firm, because you're interviewing us as much as we're interviewing you, and making sure that right fit exists, because it's going to be really unpleasant if you get into the deal and find out that you're simply incompatible for whatever the reason might be.
I just got to ask this question of you guys. What do you see the relationships with venture capital and private equity? Is it none? Is it stimulating to your deal flow, or will they never meet?
I think it certainly can be stimulating, in that venture capital is coming in and helping companies that, may have a great idea. Maybe it's the early stages of a product that could be something special or a service, and they can help take it from idea to having revenue, to having profitability. We're not getting involved until the businesses are profitable and stable, and venture capital can help get through that standpoint. So in the life cycle of the companies, it's not certainly uncommon that they would go from a venture capital firm onto a private equity firm. And to the extent that they're good venture capital firms in helping stimulate that business and help it mature, it certainly benefits us in that we get a company that's better prepared than it would be otherwise to have institutional capital in it.
So no exclusionary factor that they did A and B with a venture capital firm that they're out?
No.
I think those lines are very blurred.
Yeah.
We have a venture fund and a private equity fund. I was speaking to a business school classmate earlier this week. He works for $1.5 billion venture fund. Think about that. Their average check size has to be $100 million. That is not what people think of when they think of a venture fund. So those lines are very blurred, and you have a lot of traditionally private equity firms that are going into technology buyouts. You have Thoma Bravo and Madison Dearborn and Vista and all of these groups that are really coming into the technology space. So I wouldn't think of that distinction. Yeah. I think nowadays it's very blurred. There are capital providers at every step along the way, and a lot of them that are doing different stages.
Yeah, I love that. Chris? Yeah, just from my own experience, the evolution of early stage investing from 15 years ago, 17 years ago, that has crept up the line so far. And real true VCs have become private equity firms in many ways. And we're searching for that next early stage in the lower side, and how those lines have blurred. That's great. Yes, sir.
Where are you getting your deal flow now? Is it investment bankers, organic? Where are you getting your deal flow?
Yeah, so I head up most of the sourcing at my firm. The deal flow comes from really all over the place. So I'd say from a volume perspective, we see the most deals from sell-side investment bankers who've been engaged by an owner to go help sell their company, and they're going to go out to 100 groups just like me and hopefully transact. But we get deal flow from all over the place, from our personal networks. We get deal flow that'll come from the trusted advisors. So a business owner is looking to sell, the first person they might talk to might be their attorney or their CPA or someone like that. And they might put them in contact with us. And we also, we try to connect directly with owners. So the deal flow really comes from a wide variety of places, but I would say from a volume perspective, the most is probably coming from those investment bankers.
Yeah, I would say the best deal flow comes from referrals. The Arizona market is great at listening and hearing that owners are looking to accomplish something. So I'd say most of the time if my phone rings, it's because someone hears something and says, there's a woman, Lena Dalbey, and go chat with her and see if you can learn more. And I value that, so thank you.
In the venture and growth equity world, those are almost all from personal relationships or direct outreach. There was a comment earlier about using investment banks for venture funding. It is we take it as a negative signal if a venture company comes to us with an investment bank. That's a muscle that the CEO of a venture-backed company needs to have internally. The ability to raise capital, the ability to tell their story. And so for venture and growth equity, I can't think of us ever doing a deal that had an investment bank. In our buyout transactions, I would say the majority have an investment banker or some type of intermediary involved who has helped to prepare the company to get their financials ready to go through. Really, what was mentioned is this is a once-in-a-lifetime event for those owners. There's a lot of emotion involved, and so a lot of the intermediaries help them to get ready for what a transaction would look like. We do try all those other levers. I think nowadays it's pretty hard to find an investment over 10 million of EBITDA that doesn't have an intermediary involved.
I'd be remiss if I did not ask you guys, what can the state of Arizona do?
I mean, I think the state of Arizona is doing a lot of the right things, right? I mean, we see investment pouring in, companies are coming in, people are moving here. A lot of we have investments in California and Arizona, and I can tell you right now, it's not just the lower taxes here that make it a better place to do business. It's it's easier environmental regulations, it's easier labor law regulations. So I think Arizona's on the right path. I mean, you've got the 3 great universities putting out talent. You're attracting people. I think just continuing to nurture that business-friendly environment and create the environment for businesses to grow is going to help longer term create more opportunities for business owners and for the people that work for them too.
This is something that's hard for a capital provider to say, so it'd be better if all of you said it. There is a massive myth in Arizona that there is no capital available for Arizona companies. And I can tell you this group and many other investors in Arizona are out every day looking for great businesses to invest in Arizona. So when you hear that, let them know, put them in touch with the right intermediary or with capital providers, because there is more capital here than people think. And the best advice is to tell people, don't fixate so much that there's not capital in Arizona. Let's get your company ready to be investable, to have the right systems, to have the right team in place that when an investor comes in, you're going to clear the bar and they'll be excited to partner with you.
Yeah, I'm 6 weeks into this job, and the most important thing that I've been doing is educating that there is a lot of capital here, and there's going to be more coming in. As I said, $840 million just announced in the last 12 months. We've had 7 deals over $65 million last year. We've gotten 3 deals over $100 million, and we had a $1 billion deal get done. And so we're gonna continue to educate that. I think that's really critical. I saw a hand up. Was there any other comments on that, guys? Sorry. Go ahead.
So I have a two-way question here. As the owner of a company, how long do you think it would take me to get my company ready for you to come in and be ready? And then the second part is on your side. How long does it take on average for you to actually buy a company?
Hit the readiness, just bullet points too, if you could. Not just the length of that readiness, if you guys could take that.
The readiness part, I can tell you the things that ought to be in place for you to be ready. The time it takes to get there will depend upon where you are relative to those. At a minimum, we'd all love to see audited financial statements. At an absolute minimum, you ought to have reviewed financial statements, independently reviewed financial statements. A lot of good accounting firms here in town that can do that work. Making sure you've got the full complement of management team, and that can, depending upon what your business is, that can vary from one to another. But obviously, strong CEO, strong operator, strong finance team that can produce the information that you can then make management decisions on. You probably need a sales and marketing, maybe not a full team, again, depending upon what you're doing, but some sales and marketing people. And you need to have your processes down, and you need to really understand the market you're serving and be able to communicate to us what it is you're doing and why it is that your product or service is important and is needed in the market. From a timing standpoint, I'll give my perspective on timing. From the time we're introduced to a company, maybe there's 4 weeks of back and forth and gathering initial information, and then we can sign a letter of intent that says, here's how much we're going to invest, and here's what it's going to look like. From there, it's usually another 60 to 90 days to go through the more intense due diligence and have the closing. Now, again, depending upon how ready the company is for that process, maybe getting to that letter of intent stage takes 5 months, not 1 month. But that time from letter of intent to closing is usually somewhere in that 60 to 90 day time frame.
You guys all good with that?
Yeah.
One add-on question to that I have, when I was going out shopping VC firms, I really respected the VC firms that came in and said, we're going to do this in a week. We're going to get back to you to understand if we got to go, no go. I thought those were the most buttoned up teams around because you knew that they put something on it. They were investigating it, and they weren't, letting this thing go a very long time before they would come to some sort of either term sheet or MOI or something. What do you guys think about that? Is that possible in this structure?
Yeah, well, in the venture and growth equity world, that is still very typical. A week is maybe pushing it a little bit, but if they have a data room, you might be able to go that quickly. But that's to get a term sheet in place. Then you probably, in the venture world with no debt involved, you probably have a 30 to 45 days between term sheet and close. But the firms, there is a tremendous amount of pressure as an investor in a venture fund or a growth equity fund to come to a conclusion very quickly that you can stand behind. You don't want to put out term sheets that you can't close on. That hurts our reputation. We don't want to do that. And so if we can be ready within 2 weeks to submit a term sheet, that means we have run very hard, or it's an industry we know very well. But that is very typical. When it's an investment bank process and a buyout, the banker's going to control those deadlines pretty tightly, but Mike's timeline fits pretty well with our experience.
Great.
And one of the things I think we probably all want to be in a position to do is, to the extent that the opportunity isn't a fit for whatever reason it might be, give a really quick no. The last thing we want to do, and the last thing the business owner wants to have, is to have the process strung out for 4 weeks or 5 weeks, whatever the time frame is, and hear, no, this one doesn't fit because, well, the worst example would be this one doesn't fit because this particular industry, isn't really suited for us. Well, you knew the day you met me that what industry I was in. What sort of an answer is that? So to the extent that something comes up early in the process where it's a red flag and we know we're not going to overcome it, give the no right away rather than trying to find a rationale to keep the conversation going.
Yeah, I've lived by that. Quick no is the best gift you can ever give.
Andy, quick question. In this environment, we're moving more from a large government to a small government from a federal standard, and so that's creating very unique public-private partnerships, especially in contexts like opportunity zones where you're seeing private capital and private equity. What is the general appetite for that type of transaction where you might have a public entity that's not been working in the capital world, but partnering with a private firm that is, and the appetite to inject innovative capital in that way?
Maybe we want to tackle that.
Unfortunately, the answer for me is it's outside of anything I've ever done in terms of investing public-private partnerships, and so for our firm, it's not something that would fit. We wouldn't be the right investor. I know there are firms out there that do it. For us, it would be a non-starter.
I think opportunity zones are interesting, and there's a lot of capital going toward those. Our firm typically would view government involvement as a significant risk. So we have a checklist, and one of the items is single event risk. And government partnerships we view as a single event risk. It's a long reputation. It'll take a long time to change. I think that's more of a risk to the business.
Yeah, just a comment. I think definitionally on that specific topic of opportunity zones, there's still a lot to be learned on exactly what that investment criteria is going to be, the 10 years, and so I think that's still to come.
That's another good point on the the opportunity zones and the 10-year time frame. Lena and I were talking about this last night. For firms like ours, a 10-year investment is an eternity. We're structured where we're expecting to hold our investments for 4 to maybe 7 years, and our investors are expecting their capital returned within a time frame like that. So something where we'd have to have the money out for 10 years simply doesn't work.
I've done enough deals in my life that I've figured out, both as a buyer and seller, that finding the right match is critical. And I'm pretty good at judging what I'm good and bad at. Probably the best thing I'm good at is knowing what I'm not good at, right? But I have a difficult time determining who the parties are on the other side who are going to receive my message. How do I sift through the hundreds of firms that are available to try to find a person that might be a match for me? I don't want to waste your time either.
That's a great question.
I don't have any idea how
I think
to
that's a great question because of the different investing profiles, whether or not you're looking to completely sell your company or get an investment or exit. So I think there's some good information to share on that.
One thought with regard to that, and we had the service providers up here a little bit earlier, which can be really valuable advisors to a business owner as they're starting to think about this. Many of them have worked with a number of private equity firms over a long time frame. And to the extent that they understand you and how you like to operate and get an understanding of the items and issues that are important to you, they can help you narrow down that list of potential partners and say, this group isn't a particularly good fit for you because here's how they like to operate. But geez, this group of half a dozen could be worth your time to sit down with. And so you can rely on, I would say you can rely on people that have a broad network and have worked with a broad network of investors historically and know what they like and how they like to operate and have them think about how those groups do or do not fit with you and how you like to operate.
That's fantastic. Listen, I want to thank this panel, great group, and really informative information. Thanks, guys.